and a very warm good morning. You're watching News9. I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy. First up, let's begin with markets. To my left is my colleague Suyash Maheshwari.
Hi, Shweta. Good
Suyash, Nifty, Sensex both trading flat this morning.
Yes, Shweta. So after we saw some selling pressure yesterday, Indian markets also opened, on a flattish note with a negative bias in today's morning session, which was because of a negative handover from US markets, where we saw a 1% fall in index led by heavyweights such as Apple, which by the way fell about 2% even after it unveiled the iPhone 15. Now, global equity markets pretty much were trading directionless in yesterday's trade. This is because now we have a big event coming on. US is going to come out with its CPI inflation, the retail inflation numbers later today, and the expectation will also, and the result actually will give some cues as to what FOMC's interest rate path would be. So investors have pretty much taken
jittery.
They are jittery. They have adopted a wait and watch mode. Now, one of the big stories from yesterday's session was that the mid cap and the small cap index, which have been which have seen a one-way rally, have been rallying since the start of the year. Both indices are up about 27 to 30% since the start of financial year 2024. Finally saw some profit booking, which is actually one of the worst in its kind. Now, Nifty mid cap 100 and the small cap index 100. Mid cap 100, Shweta, by the way, fell about 3% in yesterday's session. It opened in the green. It was up about 0.5%, but by 9:40 in the morning, the mid cap index is down by 1%. The concerns are valuations are elevated. Similar story with the small cap index. The small cap index ended with losses of about 4%, formed a long bearish candle. It was down about 0.8% in today's morning trade.
All right, so both Nifty, Sensex opening flat. Joining us at this point is Vijay L Bhambwani, author and CEO of BSPL India. Vijay, thanks very much for taking time out, sir. Good to have you back. What's weighing in on markets this morning?
Good morning, Shweta, and thank you for having me on your show. It's always a pleasure and privilege to join you. Well, what we did see was some amount of profit taking finally step in yesterday, and that profit taking is getting extended. Let's not forget, we are at an all-time high, and whenever a round number and an all-time high, take for example the psychological threshold of 20,000 on the Nifty index. Now, whenever such an all-time high with a round number is reached, there will always be a segment of the population, the investing population, which says, okay, this far and no further. I've made enough money. I think the market has rallied enough and I want to exit. This is a part and parcel of change of ownership, as it is called. So these impatient short-term traders, the weaker hands, will exit. The stronger hands who are wanting to buy are in no hurry to buy. They put in their bids or their buy offers on their computer screens at marginally lower levels. So in order that their pending orders get filled or initiated, the market has to come down and execute those orders, which is what happens routinely at new highs and peaks. I would not read too much into it. This is volatility that is routine. It's a part and parcel of price discovery mechanism. An absolute long-term investor with 3, 5, and 10 years viewpoint and time frame should not really be looking into it. It is a concern for the intraday trader, not a long-term investor.
Vijay, actually, as you said, the long-term story remains intact. And since I cover stock markets, a lot of people, young people my age, in their mid to late 20s, ask me, where should we invest? Now, I'm not a market expert, but I told them that we'll have Mr. Vijay this morning, and I'll ask him, for new investors who are just stepping into the market, with a long-term investment horizon, how do they approach market at current levels?
So yes, that's a very poignant and very important question. Where do you invest now? How much do you invest, and should you go all in at one shot? Number one, never deploy all your money at one go. Always keep the powder dry, leave some room for averaging downwards, which means you stagger your investments. Number two, when you're a new entrant in the market, it makes sense to go for quality companies. They're not cheap. Prices might be in triple and 4 digits, but there is a reason why they command such lofty prices. They are tried and tested. And resort to asset allocation. Don't put all your money in one basket, which is equities. A lot of investors, especially India specific, tend to think that equities are the only game in town, which is not right. You have commodities, you have foreign exchange, you have bonds, uh, uh, you have currencies. Of course, many of these, like commodities and currencies, are not delivery based markets, except for bullion. In commodities, you can't really take delivery of anything else. So, bullion, I think you should allocate 10 to 20%, depending on your age group. If you're in your 20s, maybe 10% to 15% ought to be enough. If you're 40 plus or 50 plus, then at least 20% of your money should be in bullion. And what to buy now? I think FMCG, fast moving consumer goods, because our 1.4 billion population base itself makes it a fairly good long term story. Technology is another sector which, in all likelihood, will do pretty well over the coming decades. Um, I think pharmaceutical sector, the blue chips in the pharma space, would be another sector which you can look at. Always have some amount of money in fixed income. People from my community, they say you should enter into risky ventures, for example, investing and trading or any other business, and risk your capital only after you have allocated enough money in fixed income, especially sovereign based guaranteed investments, like, say, RBI bonds that will give you interest equivalent of running your house should your business not do well for a few months or maybe a few quarters. So do not put all your eggs in one basket and resort to asset allocation.
All right, fair enough, especially for young people. Suyash made us feel old in that one statement, but I think overall, perhaps wisdom that always comes in, and whoever I've spoken to so far, including Vijay, says that do not put all your eggs in one basket. I believe that's the strategy for savings and making money. But as far as tracking all other sectors is concerned, and especially small cap, mid cap, Suyash, they have rallied far ahead of the broader markets. But that rally seemed to be now tempering in a way.
Shweta, yesterday we saw one of the worst falls in recent times in the mid cap and the small cap indices, and analysts, at least from what I am reading, are expecting that at least in the very short term, the trend may have turned bearish in the segment. Now, we did some number crunching this morning, and we also looked at the valuations. Now, if you can have the valuations chart on the screen, please. So currently Nifty is trading at a 1 year forward PE of about 20.3x, which is slightly ahead of its 10-year average of about 18x. Now look at mid cap, Shweta, 25.2x or PE it's at current levels, whereas 10-year average is about 20.1x. Now bear in mind these are not bubble kind of levels. They are, although significantly ahead of the 10-year average. Even in the small cap space, we can see the current PE, 1 year forward PE, stands at about 20x, whereas historically in the last 10 years it was about 16.6x. Now I included Nifty Bank in the space because it's one of the sectors that are actually trading at a discount to its historical valuations. Now in the last 10 years, Nifty Bank has had a PE of about 16x, whereas currently it has a PE, 1 year forward PE of about 14.2%. Now since the point is the Nifty Bank at least currently seems undervalued, and Nifty and the banking and the financial stocks, they attribute about 38% of the entire Nifty basket. So is there a point is there a case that banking stocks will perhaps drive Nifty to higher levels, at least in the near term or in a mid term, sir?
Well, Suyash, if I got the gist of your question, you were asking if the bank Nifty can propel the broader markets to higher levels in the near term. Am I right in
Yes, sir.
assuming?
Yeah, yes, given that they
Well,
have been underperformers lately.
right. So, our in-house studies that we conduct based on statistical beta, which is pure volatility, and alpha, which is absolute returns. So your bank Nifty has underperformed the Nifty 50 on 5 weeks, 10 weeks, and 20-week time frame. As a matter of fact, over the 10-week period, you have rankly underperformed the Nifty 50. And let's not forget, the weightage of banking and financial sector services in the Nifty is in excess of 35%. So you say out of three engines in an aircraft, one engine is underperforming or is underpowered, which is why the Nifty is at 20,000 odd levels and not 20,500 or 21,000. It is purely because banking and financial sector services have been lagging behind. And this is not really a surprise. It's not rocket science. You have cost of funds, which is coupon rates, which are going up. Now, we all know that easy and ample supply of money at low interest rates is mother's milk to a bull market. Now, when interest rates start to go up, money taps tend to tighten, and interest rate sensitives, banks and financial sector companies are interest rate sensitive. So, take for example a bank or an NBFC. Money is both a raw material and a finished product because it borrows from the depositor and lends it to a borrower. So, when the cost of money is going up, the raw material and the finished product must get expensive, which is why this sector is underperforming. Now, one of the two things must happen. Either the Nifty comes down to a level where both Nifty and Bank Nifty start to give you similar return on investment, or the Bank Nifty moves up and plays catch up with the Nifty 50's return on a 5, 10, and 20-week return on investment basis. Currently, what I told you earlier, change of ownership, weaker hands getting out, stronger hands getting in, is in process. So, in the absolute near term, there is a possibility that the Nifty might cool down. I'm not saying it will fall. It could go sideways with the Bank Nifty moving up a little. There might be consolidation and a cooling off in the Nifty, but over a period of time, if you take a look at it from a long term perspective, both will start to move in tandem where the Nifty and the Bank Nifty will start giving you similar results. So, 3 to 4 months down the line, I think a Bank Nifty should be in a better place than where it is right now in relative comparison to the Nifty 50. I'm not saying absolute, I'm saying relative comparison.
Sir, what's your opinion about the mid cap and the small cap space? We have seen them; they have run fervently in the last, since the start of the financial year 2024. They are up about 30 to 40%. Now, from what I'm reading, at least many experts are saying that large caps can play a catch up. But what's your opinion about mid cap and the small cap stocks? Is it a hurdle? What's the long term story, sir?
Well, I've been in this market since 1986, and what I have seen from mid cap and small cap spaces that in a good market, in a bull market, and everybody loves a bull market, right? These stocks tend to be multi baggers. But that's only part of the story. What happens during bearish phases? I'm not saying bear market, I'm saying bearish phases. In a bearish phase, these stocks can halve or even fall further. So what is 100 can become 50 or even 25. In a bear market, they could go even lower. I've seen stocks become penny stocks and then go up to triple digits. So as long as there is a retail segment in the market and retail investors and traders love buying shares cheap. By cheap, I mean low price. As long as there is retail space in the market universe, mid cap and small caps will always find buyers. But you need to understand that you are either going to see your capital double, triple, or go up more, or you're going to see it come down by half or even less. So it's a feast and funeral segment. You need to be very strong in the gut to be able to take this kind of volatility, and you need to be extremely patient. I think people who are looking to get rich quick are people who are latching on to momentum. Just because the stock is moving up on 3 or 5 day basis continuously, they assume that the sixth day will also be a bullish one, and therefore let's buy in the morning only to get out in the afternoon. That logic does not work here.
All right, Vijay. And as we continue to track markets, let's also quickly take a look at the top stocks that we are tracking this afternoon, this
Certainly,
morning.
Shweta. So, Paytm was one of the stocks that I was looking at this morning. Paytm, now the CFO Madhur Deora said that Paytm will not require funding in near term, and as since it's sitting on a cash balance of about 8,300 crore, and they expect that owing to free cash flow, the company's profitability will become sustainable. Now, Paytm has been one of those stocks, Shweta, that has seen significant news flows in the recent months. In the last 6 months, the stock has surged about about 47% or so. And although we are seeing some profit booking, whereas the stock has corrected about 2 or 3% in the last 15 days or so. But a slew of positive trigger news coming out. Now, Paytm turned profitable ahead of its estimates. Antfin has reduced its stake significantly, whereas Vijay Shekhar Sharma has amped up his stake significantly. So the concerns about Chinese ownership in the Paytm company has also come down. Also, the company has introduced a soundbox system, so
That
they are
is
making
correct.
they're making strides. The AI program that they are working on. So, sir, just want to understand, how does one trade in Paytm stock at this point in time, sir?
Well, like I said, get rich quick is not a good system to deploy in technology space, financial company like Paytm. You need to dig your heels into the ground and take a patient approach. I think the stock, or the company rather, is uniquely poised. It's not just a payment gateway or a e-wallet. It's getting into multiple streams. And a couple of years down the line, this company will have revenue streams coming in from multiple sources. So, do you really want to time the market and say, I want to get in at so and so rupees and so paise with a target of so and so rupees and so paise? I don't think so. I think you need to take a 3 to 5 year view to be able to make money out of this stock. And you also need to understand that anytime stocks that are in this space can actually see 10, 12, 15% decline over a quarter or two. And you need to ask yourself whether you have the stomach to see this kind of a bone crunching decline during the phase that you're going to be invested into the company. If you think the answers to these questions are yes, I think you need to go ahead.
All right, and another stock that we're tracking this morning is Infosys. Infosys has signed a deal with Stark Group, albeit the stock is down very marginally. Doesn't look like there is an impact on the stock.
Yes, Shweta. So the stock has also run up significantly in the last month or so. The stock is up about 8%. Now, the news trigger for today's session is that the company has entered in an agreement with Stark Group, which is Europe's largest retailer and distributor of building materials, to establish a state-of-the-art data center in Denmark. Now, we don't know what the details of this deal are, so we don't know what sort of a contract this is going to be. But it's a positive for Infosys. And Infosys, as I said, had been an underperformer since the start of the year. We are seeing some bottom fishing in the stock. The stock has given significant returns in the last 15 days or so, but it has largely outperformed IT mid-cap stocks and also peer companies like TCS, HCL Tech on a year-to-date basis.
All right, Vijay, what's your outlook on the IT stocks as a bouquet at this point?
I remain optimistic on this sector. Number one, you are seeing strength in the US dollar index. Number two, I don't see how the world is going to get less and less technology centric. I think we are going to increase our dependency on tech. It's there everywhere, from your mobile phones to your smart TVs, and shortly even driverless cars. So, where Infosys is concerned, I think 1600 to 1650 is an area of resistance. The closer it gets there, I think you'll see, like I said, change of ownership. Weaker hands will get out and stronger hands will get in. Will it overcome the 1600, 1650 mark? I think yes, ultimately it will. That is when momentum traders will start to enjoy short-term profits coming in. Long-term investors, I think in the entire IT space, especially the large cap, Infosys, TCS, Wipro, HCL Tech, I think take a 3 to 5 year view and you're in a good spot here.
All right, and before we conclude, I have to ask, IRCTC is down by about 2.25%, Rail Vikas Nigam down by about 4.7%, IRFC down by about 4.5%. Just like there was no idea or inkling of why railway stocks are moving and moving very positively, we don't know why they are down in the last 2 days.
Well, this is again, like I said, change of ownership.
Okay?
You had the herd mentality which got into these stocks because they were moving up. If you ask people on the street, an average Joe on the street, why are you buying? Because hey, it's going up since the last 3 days. He assumes linear extrapolation that something that is in motion will continue to remain in motion in the same direction. So this is the small fry, the short-term guys, weaker hands, getting off the bus because they feel the bus is going to reverse direction. This would be a time when the stronger hands, like I said, will bid at lower levels. They'll want the weaker hands to exit so they can get their teeth into the meat and buy at lower levels. So for the extremely patient investor, I think you need to wait a little, let it settle down. It might come down a little more, and then you could commence buying.